Victor Shih is a professor at Northwestern University in the U.S. He's been looking at loan data from more than 8,000 government entities. And Victor joins us this morning in our Hong Kong studios, visiting us here in the region. Victor, let's talk about these warnings. I mean, it sounds pretty hectic. A possible financial crisis erupting in 2 years from now because of bad debts in China.
So this was, in a way, sort of misunderstanding by the media. Someone from Bloomberg actually asked me what the worst case scenario was. And for me, the worst case scenario was a financial crisis. But of course, I don't think that's very likely because China has a huge amount of foreign exchange reserve and also pretty robust fiscal resources. Having said that, I don't think we should completely discount the possibility of financial crisis. There are increasingly channels to sneak money in and out of China. And of course, capital flight is oftentimes an incipient factor for financial crisis.
Okay, so that's a worst case scenario.
Yes.
It's a financial crisis being triggered by bad debts in China. What's the most likely case then?
The most likely case is that the Chinese government will engineer a massive financial bailout of the financial sector. It's going to be very costly, but I think if the central government stops local governments from borrowing even more money from the banks now, they can engineer financial bailout around in the neighborhood of 3 trillion RMB.
Now, what I found surprising in your report is you talk about this covert hiding of debt and borrowing by local governments, which might be pushing government debt to 96% of GDP next year. That's really interesting because, the Greek crisis, we're looking at 13% of GDP in debt. So China, 96%. How's that possible?
It is very much possible. And, using not very controversial assumptions, we easily come to 96% debt to GDP ratio by the end of 2011. But of course, China also have many more resources than the Greek government does today, including its massive foreign exchange reserve. And so that will play a big part in the financial bailout that is to come.
Okay, when I say how is that possible, how can local governments hide these huge debts, these huge borrowings from the central government and from really official figures in the country?
They didn't hide from the central government. This was very much intentional.
Intentional
hiding.
Yeah,
so back in 2008, when Wen Jiabao launched the big stimulus package, explicitly, a part of the package was for local governments to borrow a large amount of money from the banks to finance a lot of the stimulus project. The money would not come from the government budget because the government would like to keep explicit deficit at a relatively low level.
Okay, so that's really interesting then. But what about recently? We had the central government stepping in and saying, these local government investment vehicles, which is really what's been used to hide these huge debts, this huge borrowing. Now they can't guarantee loans. Isn't that a step in the right direction?
To me, that announcement is not very credible. To me, it's more or less meaningless. The banks have already lent a huge amount of money to these entities. And, just the central government saying that, no, we won't guarantee this debt anymore is not very much credible. The banks will continue to have to throw more money into these entities or face an immediate wave of non-performing loans. The only credible action by the central government right now is to actually allow a handful of these entities to go bankrupt so that the banks know that the central government means business when they say they're withdrawing the guarantee.
So is it too little, too late then for the central government at this point?
No, not at all. I mean, at this point, it's not. They just need more credible action. Instead of just making these announcements, which are, to me, it's not very credible, they need to actually allow some of these entities to go bankrupt. This is something that former Premier Zhu Rongji did in the 90s to signal to the local governments that he meant business by allowing entities like GDP go bankrupt.
Right, okay. So let's say China continues on this borrowing spree, or as China is going right now, shall we?
Yeah.
What about GDP growth? Because some say because of the huge debt, the massive borrowing, we could be looking at GDP growth of 5 to 7%, which, would shock a lot of people watching China.
Sure. I think if the central government makes this implicit problem explicit now, we may see a year or two of relatively slow growth. But that, to me, is much better than waiting for 2 years from now when the debt problem will be much, much bigger. And then some exogenous shock may actually cause a more serious problem. I won't say crisis, but a more serious problem. And the GDP cost of that by that point might be much larger.
Much larger in what sense?
In terms of duration of the growth slowdown and also the cost of the central government in having to bail out the banks.
All right, so it could be a worst case scenario. We might be looking at another financial crisis. Worst case, yes. Okay, Victor, thank you for joining us today. That's Victor Shih of Northwestern University.